advisor here at FWO Chartered Accountants, and today we're going to be covering off on the keys to investing, and I'll get started. So the keys to investing. So this presentation today is aiming to highlight the critical factors in the pursuit of a better investment experience. So there are 5 critical keys to that, and firstly we've got risk and return and how they're related, the asset allocation decision, 3, diversification, 4, rebalancing, and 5, staying focused. Risk and return are related. So the higher the risk, the higher the expected return, and conversely, the lower the risk, the lower the expected return. So really what this is just highlighting is the fact that you've got different investments, and some will sit differently on that curve there, dependent on their expected risk and their expected return. If we now have a look at the different asset classes, if you like, and where they sit on that graph in respect to their expected or potential return and risk, you can see that shares are at the higher end. So you've got a higher expected return, but at the same time you've got that higher expected risk. Conversely, you've got cash down the far left. So it's considered to have the lowest risk, but also with that comes a lower expected level of return. So this relationship really underpins the basis of all portfolio construction, and really it's integral to the success of an investment portfolio. Next, we have the asset allocation decision. So there are 4 main asset classes that people can invest in. 1, we have cash. 2, we have fixed income or bonds. 3, we have property. And lastly, shares or equities. So starting off with cash, cash has the highest level of liquidity. So cash is typically held to maintain a certain level of liquidity in a portfolio, and also it has the lowest level of risk, therefore its expected rate of return is very low. Next, we have fixed income or bonds. Essentially, these are an IOU or a loan to an entity such as a government, state, or company. Bonds are contractual obligations that usually involve interest payments paid by the borrower at regular intervals, and ultimately the return of your initial investment at the maturity date. Bonds are generally considered to be a lower risk, lower expected return investment on the scale. Next, we have property. Property is the ownership of physical real estate, be it residential or commercial. Property can be included in a portfolio in the form of listed equities, managed funds, property trusts, direct ownership, and unlisted trusts. So in general, property investments are considered a higher risk or higher level of return, expected return. Lastly, we have shares or equities. So with shares, essentially it's an ownership interest in a company. If that company does well, as a shareholder, you should benefit from its rising stock price. The company might also pay a discretionary dividend to shareholders in the form of cash or more shares of the stock. If the company does poorly, its stock price might go down, causing your shares to decline in value. There are many factors that can affect a company's stock price, many of which are completely external to the company itself. In general, equity investments are considered a higher risk and higher expected return investment. So it's important to understand that the primary driver of investment return is the risk, specifically the riskiness of the asset classes you have in your portfolio and how you allocate your investment dollars among them. To highlight the importance of an asset allocation decision, there was a study conducted in the US on the 91 largest pension funds over a 10-year period back in 1990. And this was published by G. Brinson and L. Hood and G. Biebauer. And the paper was about the determinants of portfolio performance. And what they found during their study was that across those 91 largest pension funds in the US over that 10-year period, their findings highlighted that 94% of the asset class selection was the main determinant of the actual portfolio return. So the other areas where you've got security selection and market timing making up a much smaller portion of the return that was generated by those funds over that period of time. Similar in Australia, a similar study was conducted by Vanguard, and it was a white paper on the global case for strategic asset allocation. And what they studied was the returns, the monthly returns of 336 Australian balanced funds from January 1990 through to 2011. And the results were almost identical. So once again, the asset allocation had almost a 90% determination of the actual investment outcomes, so the return. And you can see there that the security selection and actual market timing decisions of that portfolio only made up about 10% of the return. Next, we're going to be talking about diversification and what that really means for your portfolio. So this chart here, you can see that you've got your risk and return X and Y axes here, and we can see here that as we have a higher allocation to equities, the portfolios go into a higher return category, expected return. But at the same time, their risk is increasing with that higher allocation to stocks. And you'd expect this given that stocks or equities or shares are deemed to have to be more risky than bonds. So we can see here that a portfolio with 100% worth of bonds has the lowest risk, but also the lowest expected return out of all these portfolio combinations. And as we increase our holdings of stocks, you can see that the expected return is increasing, and at the same time, the expected risk within that portfolio is also increasing. So it's important that once we've established our asset allocation, that you focus on the diversification between the different asset classes. So most people understand the concept of not putting all your eggs in the one basket. However, most do not understand the concept of effective diversification and what that really means. So by way of simplistic example, in the early 2000s, we had the technology bubble. So if a computer executive working for a technology company, in an effort to diversify his large holdings of technology companies, bought another 20 technology companies, he thought he was diversifying and was a smart decision to stay within an industry that he knew. Well, unfortunately, when the technology stocks crashed as an industry, his wealth would have been severely damaged. So thus, just because you've diversified across more than one company doesn't necessarily mean that you've got adequate diversification. That moves us into this next chart. Now, it's a very busy chart, I know, and what we just want to highlight here is that with diversification and its importance, it involves holding more than one stock or one sector or one country. It's about diversifying your portfolio across asset classes within asset classes. So this patchwork sort of periodic table, if you like, is showing the highest rate of return for the calendar year, for the financial years from 2000 to 2013. And these different colours at the top here are corresponding to the different asset classes, with be it Australian large companies, small companies, value companies, right down through global equities, emerging markets, property, cash, and fixed interest at the bottom. And each colour corresponds to how it's performed each year. So there's no real pattern in the best performing asset class up here at the top. So for instance, in 2011, we had Australian small companies returning 16.4%. So it was the best returning asset class of that year. And then the very next year in 2012, lo and behold, it was the worst performing asset class out of all the asset classes. So what this is really highlighting is that it's not just about picking the best asset class from year to year, but about timing, and it's not about your timing of moves in and out of the best performers. So that's awful lot of decisions to get right. So the only way to get sufficient exposure to the highest performing asset classes each year is to incorporate them into your portfolio. So next, we're wanting to talk about rebalancing and how rebalancing applies to all portfolios, be it your investment portfolio, your superannuation portfolio, your self-managed super fund. So rebalancing your portfolio really is an integral step in keeping your investments on track. Rebalancing is not based on forecasts, but rather the fact that your portfolio has drifted away from its original asset class percentages and needs to be put back on track with its target allocation that you started at the very beginning. So, for example, if equity markets enjoy a period of strong returns, similar to what we've just recently experienced, ending 2013, it's possible that a 60-40 sort of stock bond portfolio could drift to a 70-30 mix, and therefore if it was left alone, that portfolio would have a high level of risk, which could turn out to be at a market high point. Thereby rebalancing it back to that 60-40 combination of stocks and bonds that you commenced with, you can maintain your desired level of risk. So a good example of where investors got caught out was back in 2008, 2009, and having an asset allocation which had drifted into risk levels which did not align with investors' risk appetites. So during that period of time, equities had a big run, and then you saw those negative returns with the equity markets crashing on the back of the global financial crisis. So really, the opportunity cost of having your portfolio drift into that higher risk category can be disastrous. Probably one of the hardest things for people to understand is psychologically, rebalancing is counterintuitive, and it's difficult for many investors to comprehend. We think this way because our intuition really tells us to follow trends, and we want to buy more of what has done well recently and sell what has done poorly. And this can cause us to buy high and sell low, the exact opposite of what we should be doing. So by rebalancing, it's an automatic way to buy low and sell high without having any emotions getting in the way. So the importance of rebalancing and the benefits of rebalancing come from keeping your allocation of your assets in line with your allocation targets, which allows you to maintain your chosen level of risk. So by carefully selecting your risk profile based on your risk tolerance, your investment time horizon, and other important factors, you don't want any market movements to be dictating any changes to your portfolio. So what I've done is I've created a hypothetical portfolio which has just been invested across the broad indexes for each of the asset classes for cash, We've got the UBS Bank Bill Index with an allocation of 5%, fixed interest with the UBS Government Bond Index with a 25% allocation, Australian shares, we've got the S&P ASX 300 accumulation with 20%, the Australian Small Companies Index with 10% allocation, international shares with MSCI excluding Australia in the index at 20%, the World MSCI Small Cap Index at 10%, the Property Trust Accumulation Index with a 5% allocation, and emerging markets. And this particular hypothetical portfolio has a 70% weighting to your growth assets, being your Australian shares, international shares, property and emerging markets, with only 30% left with your defensive assets. And so with these two portfolios, I've got the results of what the performance would have been from the end of December 1998 through to the end of December of 2013, and what effect having a portfolio that's never been rebalanced and what a portfolio with an annual rebalancing has on the actual return. So over that 14-year period, we can see that the annualized return for that portfolio that's never been rebalanced is just over 6%. And conversely, the portfolio that's been rebalanced annually has an annualized return of 6.53%. So the portfolio which has been rebalanced annually has a higher annualized rate of return, which might surprise some people. And conversely, also we've got here the standard deviation. So the standard deviation measures the risk within a portfolio. And so what we can see here is that by letting the portfolio drift into a higher risk category, the standard deviation has increased, but also that return is less than what you would have achieved had you had an annual rebalance of your portfolio. So not only are you reducing the risk in your portfolio, but you're also getting an increase in performance. And once again, this is the same two hypothetical portfolios. This chart's just showing how they've the rate of return, the growth of wealth of $1, how it has performed over those 14 years. And you can see that up here at the end here, the green line represented by the annual rebalance portfolio has actually grown significantly more than the portfolio which was never rebalanced. And if we follow the chart, we can see here, just pre-GFC, with this sort of portfolio, that the portfolio did drift to that higher allocation with the equities. And we can see the downside here after the GFC, down here in 2009. And what's sort of transpired since then has been that by having the portfolio stick to its target allocation, if you like, it's mitigated the risk within the portfolio and achieved that higher annualized rate of return, which at 0.5% year on year, that's not insignificant when you're talking about large sums of money, and over even longer timeframes, that sort of level of outperformance can actually be a lot of money within a portfolio. This next chart really just it highlights the fact that the annual rebalance portfolio, we can see here that it's on the matrix of the annualized return, and down the bottom here we've got the standard deviation, so the level of risk in the portfolio. So this portfolio had the annual rebalance portfolio had a standard deviation which was 7.6, and it had a rate of annual rebalance of 6.53. So we can see that by having a higher return and a lower risk, it's a much better portfolio than the portfolio which has never been rebalanced, which has a lower annualized return and a higher risk category. So the next key that I wanted to highlight today was staying focused. So it's quite important not to confuse entertainment with advice. So the television and print and online and financial media are in the business of entertainment. So really, their emphasis is really on the short-term, sensational and emotional charged headlines. So really, these messages can compromise long-term focus and discipline and lead to poor investment decisions. So it's really important to ignore some of the white noise that you hear on the news and in the papers typically. A good example is the news headlines typically these days. They're starting to talk in dollar terms of the fall in the market. So you typically hear a headline that the Aussie market has lost $30 billion in a day. And really, that's all about just getting a headline. It adds to the anxiety to some investors, but really it's important just to ignore a lot of those sensationalised headlines and maintain your long-term focus on your goals. So managing your emotions and avoiding investment mistakes. So there's some cognitive errors that a lot of people can make, and also the investment pitfalls that are evident in whatever type of investment decision you're trying to make. So with overconfidence, so a general disposition to be overconfident can help society in many ways. For example, without a bias to overconfidence, many new inventions or companies or research would never come about. However, we need to understand that overconfidence with regards to investing can be detrimental to the financial health. So success in one walk of life doesn't automatically translate to success in investing. Unfortunately, many highly accomplished people have learned this lesson the hard way and through severe investment losses. So overconfidence is one error and one emotion that we always look at managing. The other with attraction to rising prices. So when prices for most consumer goods, such as fuel or meat or beef, rise, people tend to either cut back or find a substitute. However, with financial assets, the opposite seems true. So many investors are more attracted to a stock price which has risen than those that have fallen because they're incorrectly looking at the past price change into the future. So it's important to remember that because past performance is not really an indicative of future results. So it's always important to keep that emotion in check. Next, we've got sort of the herd mentality. So what that's talking about is that there's a comfort in being part of a group. So when others are doing something, we're more comfortable and more inclined to do the same. Of course, history has shown that when a herd moves in one direction, it may be time to consider going the other way. So having an appropriate rebalancing strategy, for example, will help avoid having this problem following new trends or making tactical decisions on assets within your portfolio. And also, lastly here, we've got fear of regret. So we're often reluctant to make investment decisions for the fear they'll turn out badly. For example, if you have left money sitting uninvested because you're afraid to enter the market at the wrong time. So this typically can happen to investors, and our view is that really the right time to invest is when you have the money, and the right time to sell is when you need the money. So you can put that fear of regret to the side. So with market fluctuations, that causes us to continuously battle these biases that we all have as humans. And so we really need to have discipline to counter these human tendencies. And look, some of the investment pitfalls that investors can fall into is by not having an investment plan at all, by chasing performance. So chasing that outperforming fund manager or asset class or stock, that can actually be a pitfall. Having over concentration, so that really is talking about having too much of a particular asset class within a portfolio, or not having your portfolio properly diversified across different asset classes and sectors. Also, market timing, that's a big one. Being out of the market has been constantly proven that for every day out of the market, if you miss one of the best days of returns, you're significantly reducing your ability to maintain a long-term expected rate of return in line with the market, and also having a wrong time horizon. So that can also be having an over allocation to growth assets when nearing retirement, or having your risk within your portfolio not matching up with that time horizon. Forecasting, so typically this is fraught with danger. You'll hear economists try and predict where the Aussie dollar will end up. Most of the time they'll get it wrong. So this type of pitfall, it's all about controlling what we can control, and making sure that our portfolio is managed in regards to having our asset allocation clear, having our portfolio properly diversified, having a rebalancing strategy, and staying focused. So in conclusion, the 5 key areas that we've covered off today with risk and return are related, and how that relationship works for all investment portfolios. The asset allocation decision, and how that affects our portfolios. Diversification, so ensuring that by having a properly diversified portfolio, we can reduce and mitigate risk within our portfolio. Next, we've got the rebalancing of a portfolio. So as we saw in the example with the hypothetical portfolios, that by having a disciplined approach to rebalancing, we're not letting our portfolio drift into a higher risk category, which we're not comfortable with. And lastly, staying focused. So ignoring the white noise that we hear from the media, having an investment plan, and really ensuring that we're doing everything that we can within our powers, within our control, to ensure that we achieve the investment goals that we're looking to achieve. So that brings me to today's offer. So on the back of what we've talked about today, I'm more than willing to provide a free consultation of your existing investment portfolios. So please feel free to contact me on my email at tim@fwo.net.au, or you could also call me on 0738 333 999. So I'd just like to take this opportunity to say that please take advantage of this offer, and as this is the first step in creating a concrete investment plan for yourself. And thank you for attending today's webinar, and I hope to speak with you soon. So thanks.